Corporate taxation is one of the more complex parts of a financial model, so this video will provide an overview of corporate taxation concepts, each of which will be discussed in more detail in their own separate videos. When your historical corporate taxation information is brought into your financial model via your accounting package, historical tax expense is brought into the historical income statement and is located at the bottom of the sheet between net profit before tax and net profit after tax. And your historical corporate tax payable is brought into the historical balance sheet within the current liabilities section above interest payable. And if we scroll across our time series to our last period of June 2022, you can see we have a closing corporate tax payable balance of 86.6. If you've chosen one of the more complex charts of accounts, the historical balance sheet will also include deferred tax assets within the non-current assets section and deferred tax liabilities within the non-current liabilities section. And when forecasting corporate taxation, this is handled on the taxation sheet and is located at the bottom of the sheet below other forms of tax if they're included in the chart of accounts you've chosen, such as payroll tax or GST. Before diving into the details, let's first look at the financial statement impacts to understand why corporate taxation can get complicated. In a perfect world, tax expense on the income statement would equal tax paid on the cash flow statement, and that would be the end of it. Tax expense would decrease net profit after tax on the income statement, which would decrease total equity on the balance sheet, and tax paid would decrease operating cash flows in the cash flow statement, which would decrease cash on the balance sheet and therefore total assets and net assets, thereby balancing the balance sheet. In reality, corporate tax liabilities are usually paid in periods after the period in which they're incurred, which results in corporate tax payable in the current liability section of the balance sheet, reporting the amount of unpaid corporate tax at the end of each period. But where corporate taxation can get quite complicated is that there are often differences between the way tax is reported for accounting purposes and the way tax is calculated when businesses submit their tax returns. We call these differing calculations accounting world and tax world calculations. These differences require a range of adjustments to be made when forecasting corporate taxation and are the reason why tax expense is not equal to the corporate tax payable by a business and why deferred tax assets and liabilities often need to be reported on the balance sheet. Let's now work through how this is done in a financial model. Looking at the top of our corporate tax analysis, in this example, a June tax year end and a 30% corporate tax rate has been assumed, with no tax losses and 100% of the opening tax payable of 86.6 being brought through from our historical balance sheet is assumed to be paid in the first forecast period of July 2022. The periodic tax payable assumptions are used to calculate the forecast tax expense and tax payable by the business, which will differ due to differences between the accounting and tax treatment of certain revenues and expenses. Finally, the tax payment timing assumptions are then used to determine when tax assessments take place and when the resulting tax liabilities are paid to the tax body. In this example, quarterly tax assessments have been assumed, with tax payments being made in the month after the end of each tax assessment quarter. The remainder of the corporate taxation analysis forecasts each of the corporate tax components based on these assumptions, starting with tax expense and tax payable before allowing for tax losses, tax assessments, and deferred tax assets and liabilities. Each of these more complex components will be discussed in more detail in separate, more advanced videos, so for now, let's walk through the main tax calculations. The first thing that's calculated is the accounting tax world tax expense, which is equal to accounting taxable profit multiplied by the corporate tax rate in each period. Accounting world taxable profit is equal to net profit before tax from the income statement, less any non-assessable revenue and non-deductible expenses. These are called permanent differences and are discussed within our advanced taxation videos. In this example, no permanent differences have been assumed, so accounting world taxable profit equals net profit before tax, and tax expense is equal to 30% of this amount in each period. For example, the 13.9 of tax expense forecast for June 2022. This tax expense is reported in the income statement between net profit before tax and net profit after tax. After calculating accounting world tax expense, the tax world taxable profit or loss of the business in each period is calculated by adjusting accounting world taxable profit for differences between the accounting and tax treatment of revenues and expenses. In this example, all of the adjustments are salaries and wages provisions because the chart of accounts we've used includes detailed salaries and wages analysis. For example, let's look at superannuation, which is also known as retirement or pension contributions in other regions around the world. Superannuation withheld is reported as an expense in the income statement each month, but from a tax world view is only deductible when it's paid, which in this model is in the month following each tax assessment quarter. To adjust for this difference between accounting world tax profit and tax world tax profit, the income statement superannuation expense must be added back when calculating tax world taxable profit and superannuation paid deducted. The resulting difference between accounting world profit and tax world profit is a temporary one and results in the creation of a deferred tax asset because accounting world profit is temporarily lower than tax world profit. The reporting of deferred tax assets and liabilities in this way is fundamental to ensuring that the balance sheet reflects the correct net assets of the business, but is also one of the most complex things in financial modelling. For this reason, deferred tax assets and liabilities are discussed in more detail within our advanced taxation videos. Now, after these adjustments are made to accounting world taxable profit, the tax world profit or loss for the business in each period is determined. In this example, the business has no tax losses, but if it did, these would be offset against taxable profit when calculating the tax payable by the business. Tax losses are another thing which create deferred tax assets and are also discussed in advanced taxation videos. If this business paid tax every month as it made taxable profit, the tax rate would be applied to this taxable profit in each period to calculate tax payable. But because quarterly tax assessments has been assumed, the tax payable by the business is calculated each quarter based on the cumulative monthly tax payable, and in this case, tax is paid in the first month after the end of each tax assessment quarter. An annual assessment is then done to ensure that the tax paid for the taxation year is correct, which in some cases with lumpy quarterly assessment tax payable amounts might require an additional tax payment or refund. In this case, this is not required, so the tax paid by the business during the first forecast year is the sum of the 4 assessment tax paid amounts. The end product of all these calculations is forecast tax expense, which is reported in the income statement, tax payable and deferred tax assets and liabilities reported in the balance sheet, and tax paid reported in the cash flow statement, as shown in the reconciliation and summary sections at the bottom of the sheet. Looking at October 2022 as an example, we can see we have a tax expense of 21.3 and a closing tax payable balance of 12.7, resulting from the 100.1 quarterly tax payment and 12.7 of tax payable created during the period. We then have a closing deferred tax assets balance of 19.7 and finally a deferred tax liabilities balance of 100.0. If we want to see these impacts on the financial statements within our model, we can head back to the table of contents and activate our financial statements. Firstly, looking at the income statement, we can see our tax expense below net profit before tax. If we scroll across our time series to the forecast month of October 2022, we can see the tax expense of 21.3. Then, scrolling down to our balance sheet, we have our corporate tax payable balance in our current liabilities with our closing balance of 12.7, decreasing from 100.1 in September 2022. In our non-current assets, there is our deferred tax assets balance of 19.7, and in our non-current liabilities, our deferred tax liabilities of 100.0. Finally, scrolling down to our cash flow statement, within our operating cash flows, we have our quarterly payment of corporate taxation of 100.1, reflecting the quarterly payment of our corporate taxation payable balance from the end of the September quarter. So just to recap, when you're looking at the financial statement impacts of corporate taxation, we have tax expense on our income statement, corporate tax paid in the operating cash flows within our cash flow statement, and if there is a payable at the end of the period, a corporate tax payable within the current liabilities section of the balance sheet. If there are then differences between accounting world taxable profit and tax world taxable profit, we may also have deferred tax assets and deferred tax liabilities within the non-current assets and non-current liabilities sections of the balance sheet.